Ever stare at market data and just feel completely lost, like you're trying to read some alien script?
Oh, definitely. Prices jumping around, all those numbers.
Yeah.
It can be overwhelming.
Yeah. What if there was, a simpler way, a kind of shortcut to see where things might be going?
Well, that's exactly what we're digging into today. A classic tool that aims for that clarity.
Okay, good. So we're diving deep into pivot points today.
Pivot points, yeah, and the really crucial support and resistance levels that come with them. S1, R1, S2, R2.
Right, the whole family.
Yeah.
R1, R2, R3 for resistance, and S1, S2, S3 for support. Classic technical analysis stuff.
Exactly. And our mission here really is to give you a solid, practical handle on these. Think of it like a framework.
A framework to cut through the noise.
Precisely. So you can look at the market, get a quick sense of potential trends, potential key price levels, without feeling totally swamped by data.
All right, let's do it. So, first things first, what exactly is a pivot point? The name sort of implies a pivot.
That's a good way to think about it. In technical analysis, it's basically an indicator. Helps gauge the overall trend for a trading day.
Just for the day.
Typically, yeah, for daily pivots. And the calculation is refreshingly simple. You just take the high, the low, and the closing price from the previous day.
Okay. High, low, close.
And you average them. Divide by 3, that's your pivot point.
So it's using yesterday's action to kind of map out today's possibilities. Makes sense. But why is that one number, that average, so significant?
Well, it acts as a baseline, a kind of equilibrium point for the day's trading. Everything else, all those S&R levels, they're calculated from this pivot point. It's the anchor.
Okay, the market's center of gravity, maybe.
For that day.
That's a great analogy.
So how do we use it? If the price is, say, above that point, what does that tell us?
Good question. So, generally speaking, if the current price is trading above the pivot point, it suggests bullish sentiment. Maybe more buyers are interested.
Below suggests bearish sentiment. Potential selling pressure might be dominant. It's a quick mood check for the market.
Interesting. Quick gauge. But you also said it could be a point where things turn around or keep going.
Yes, exactly. The pivot point level itself can act like a temporary floor or ceiling. Price might hit it and bounce off. That's a reversal. Or it might slice right through it and continue. That's continuation. So it's a really key reference level that lots of traders are watching.
Got it. Okay, so the pivot point is our main reference. Now, these other levels you mentioned, R1, R2, R3, and S1, S2, S3. Tell us about those.
Right. These are derived from the pivot point, like we said. They basically map out potential roadblocks on the way up. Those are the resistance levels, the R levels.
Okay, ceilings.
Yeah. And potential floors where price might stop falling. Those are the support levels, the S levels.
Yeah, let's break them down. R1,
Yeah.
first resistance. What's the significance there?
Yeah. R1 is your first hurdle above the pivot point. Often you'll see some selling pressure appear around R1. It's a logical place where maybe traders who bought lower take some profit.
Or where sellers might decide to jump in.
Exactly. They might anticipate a pullback from that level.
Okay. And R2. That sounds like a tougher nut to crack.
It generally is. R2 is a stronger resistance level sitting above R1. If the price manages to push up to R2, it usually indicates, pretty significant buying strength.
And R3. Way up there. That must be like the final boss level.
Sort of. R3 is considered quite strong resistance. Reaching it can sometimes suggest the market is getting a bit stretched, maybe overbought, so the chances of a reversal might increase up there.
Overbought. Okay. Getting the resistance picture. Now, flip side the supports. S1. First floor below the pivot point.
S1 is the first potential support level. Similar idea to R1, but in reverse. You might see buyers stepping in around S1.
Looking for bumps?
Looking for a bounce or maybe covering short positions. It's often seen as a potential turning point or at least a pause on the way down.
And S2. Deeper support.
Yes, S2 is considered a stronger support level than S1. If the price drops down to S2, it indicates quite a bit of selling pressure, and that level might provide a more solid floor.
Finally, S3. The basement level.
S3 is that third, more extreme support zone. Similar to R3 suggesting overbought, S3 can often indicate an oversold market. Sellers might be running out of steam down there, increasing the odds of a rebound.
Okay, overbought at R3, oversold at S3. That makes intuitive sense.
Right.
We know what they are. Now, how do we actually get these numbers? What's the math?
The formulas, yes. They all stem from that pivot point we calculated earlier, plus the high and low from the previous day.
Okay, let's hear them. Maybe start with R1 and S1.
Sure. So for R1, the first resistance, it's 2 times the pivot point minus the previous day's low price.
2xpp.
Got
it. And S1.
For S1, the first support, it's 2 times the pivot point minus the previous day's high price.
2xpp. High. Okay, symmetrical in a way. What about the second levels, R2 and S2?
For R2, it's the pivot point plus the difference between the previous day's high and low. So PP plus high-low. That difference is the previous day's range.
Right, the range.
Yeah.
And S2.
S2 is the pivot point minus that same range. So PP high-low.
Makes sense. Add the range for resistance, subtract it for support. Okay, last two, R3 and S3. The extremes.
For R3, it's the high price plus 2 times the difference between the pivot point and the low price. So high plus 2, PP low.
Okay.
And finally, S3 is the low price minus 2 times the difference between the high price and the pivot point. So low 2, high PP.
Phew. Okay, that's quite a set of calculations. Good to know where they come from, but
yeah,
I assume we don't have to do this by hand every day.
Oh, absolutely not. Thank goodness for technology. Pretty much any decent trading platform like, Zero to Kite or TradingView, they have a built-in pivot point indicator. You just click a button and boom, all these lines appear on your chart.
Much better. Okay, so we've got lines on our chart. Now what? How do we actually, use them in trading?
Right, the practical stuff. First step is just reading the situation. Like we said, price above the pivot point, generally bullish bias, below, bearish bias.
And if it's stuck right around the pivot point itself?
That often means the market's undecided, kind of waiting for direction. In that case, it's usually smarter to maybe wait for a clearer signal, like a breakout above R1 or a breakdown below S1.
Wait for confirmation. Don't jump the gun.
Okay.
So let's talk specific strategies. How can these points help set up actual trades?
Okay, one common approach is range trading. If the market seems to be bouncing between, say, S1 and R1.
Just ping-ponging back and forth.
Exactly. You might look for opportunities to buy near S1 if you see maybe a bullish signal like a hammer candlestick pattern forming there.
A sign buyers are stepping in.
Right. And conversely, you might look to sell near R1 if you see a bearish signal, maybe a shooting star pattern.
And stop losses, where would they go?
Typically, for a buy near S1, you'd put your stop loss just below S1, maybe even aiming below S2 if S2 is close, just to give it some room. For sell near R1, stop goes just above R1.
Makes sense. And profit targets?
Could be the pivot point itself, or you might aim for the opposite side of the range. So if you bought at S1, target R1.
Okay, so trading the bounces within the S1 R1 box. What if the price doesn't bounce? What if it breaks out?
Then you're looking at breakout trading. If the price pushes decisively above R1.
Breaks through that first ceiling.
Yeah, that can signal the start of a stronger move up. So you might consider buying on that breakout, maybe targeting R2 or even R3 if there's strong momentum.
And the opposite for a breakdown.
Exactly. If price breaks below S1, that could signal more downside.
Yeah.
So you might look to sell, aiming for S2 or S3 as potential targets.
Where do stops go in breakouts?
If you buy a breakout above R1, your stop might go just below R1, the level that was just broken. If you sell a breakdown below S1, the stop might go just above S1. You're betting that the broken level will now hold as support for buys or resistance for sells.
Right. Old resistance becomes new support and vice versa. Got it. Okay, what about those extreme levels, R3 and S3?
That brings us to reversal trading. If the price gets all the way up to R3 and the market looks, really stretched or overbought.
Maybe momentum is fading.
Right. Maybe you see something like RSI divergence where the price makes a new high but the RSI indicator doesn't, or you see a clear bearish reversal candle pattern right at R3. That could be a signal to consider selling, betting on a reversal back down.
With a stop loss just above R3, I assume?
Precisely. And you'd target maybe R2, R1, or even back down towards the pivot point.
Ah.
Same logic applies at S3 for potential buys if the market looks very oversold and you see signs of buyers returning.
Okay, so range, breakout, and reversal. Any other ways to use them, maybe confirming a trend?
Absolutely. Trend confirmation. In a solid uptrend, you'll often see price pullback, find support near S1 or maybe S2, and then resume the uptrend. Holding those support levels confirms the trend's strength. Similarly, in a downtrend, you might see price rally up to R1 or R2, hit resistance there, and then turn back down, confirming the downtrend is still intact. You could combine this with, say, moving averages. Price bounces off S1 and stays above its 20-period moving average. That's stronger confirmation.
Okay, so seeing these levels hold adds weight to your analysis. Now, you mentioned RSI, moving averages.
Yeah.
How well do pivot points play with other tools?
They actually combine really well. We've mentioned candlestick patterns a few times. Seeing specific patterns form right at a pivot level is much more powerful than seeing them form in the middle of nowhere.
Context matters.
Big time. And indicators like RSI or MESI for momentum or even just volume can help confirm breakouts or suggest reversals are more likely at these pivot zones. Some traders also find that Fibonacci retracement levels sometimes line up closely with pivot levels. When that happens, it creates a confluence zone, which many see as a stronger potential support or resistance area.
Confluence, multiple signals pointing the same way.
Exactly. Oh, and it's worth mentioning, while we focus on the standard calculation, there are variations like Woody's pivots or Fibonacci pivots. They use slightly different math, emphasizing different things, something you might explore later.
Good to know. Okay, super important topic. Risk management.
Mm.
How do pivots fit into managing risk?
Crucially, first rule, always, is only risk a small percentage of your capital on any single trade. Like 1% or 2% is a common guideline.
Don't bet the farm.
Never. Second, use the pivot levels to help place your stop-loss orders. As we discussed, place it logically beyond the key level you're trading against. Buying near S1, stop goes below S1, maybe below S2. Selling near R1, stop above R1, maybe above R2.
Give the trade some breathing room, but have a defined exit.
Exactly. And aim for a good reward-to-risk ratio. At least 2 to 1 is a good target, meaning your potential profit should be at least twice your potential loss if the stop gets hit.
Makes sense. Anything else on risk?
Yeah, don't overtrade. Just because price hits a pivot level doesn't automatically mean you have to trade. Look for high probability setups where the pivot analysis lines up with your other tools and checks. Quality over quantity.
Solid advice. Okay, this is great theory. Can we maybe walk through a quick example with some numbers just to cement it?
Sure, let's do that. Say yesterday's stock data was high euro 100, low euro, and the close was 95.
Okay, high 100, low 90, close 95. First, the pivot point.
Right. PP equals 100 plus 90 plus 95, 3. That comes out to 95, exactly.
PP is 95. Okay, let's calculate S1 and R1.
Okay. S1 equals 2 PP. High equals 295. 100 equals 90 equals 185 R90.
S1 is 90.
And R1 2 PP. Low as 190. 90 equals 100.
R1 is 100. So the range yesterday was basically between S1 and R1. Interesting. Now, today's scenario.
Let's imagine the current price today is 97.
Okay, 97. That's above the pivot point of 95. So slight bullish bias.
Correct. Now, let's say the price pulls back from 97 down to test that S1 level at 90. And right there at 90, you see a strong bullish candlestick pattern form, like a bullish engulfing.
Oh, okay. A potential buy signal right at support. What's the trade setup?
You could consider entering a long trade, buying at 90. And now where's the stop loss? We need S2.
Okay, calculate S2. That was PP, high-low.
Right. S2 equals 95, 190, 95, 10 equals 85. So stop loss goes somewhere below 85.
Yeah, maybe just below 85, say 84.90 or something, depending on the spread. Your risk is roughly €5 per share from 90 down to below 85.
Okay, risk is about 5 rupees. What's the target? R1.
R1 at 100 seems like a logical first target. If price gets there, your potential profit is 10 from 90 up to 100.
So risk 5 to potentially make 10. That's our 2.1 reward to risk ratio.
Exactly. That's a hypothetical example of using the levels to define entry, stop, and target. That makes it much clearer. Okay, fantastic. For someone just starting out with pivot points, what are like the top few tips?
Good question. First, start simple. Don't try to track all 7 levels at once. Just focus on the main pivot point, R1 and S1 initially. Get comfortable with those.
Master the basics first.
Exactly. Second, be aware of time frame relevance. Daily pivots are mostly for intraday trading. If you're swing trading over days or weeks, you'll want to look at weekly pivots.
Right tool for the right job.
Third, know that pivots tend to work better in trending markets. In really choppy sideways markets, you might get more false signals, price just slicing through levels without much follow-through.
So assess the market condition first.
Yes. Fourth, consider multi-time frame analysis. Look at the weekly pivots for the bigger picture context, then use the daily pivots for finer entry-exit points.
Get the forest and the trees view.
Nicely put. And finally, maybe the most important, discipline. Stick to your plan. Follow your risk rules. Don't let emotions drive your decisions when price hits a level.
Discipline, discipline, discipline. Okay, great tips. So wrapping this all up then, what's the main takeaway on pivot points?
I think the core idea is like they offer a structured, relatively easy to understand way to identify potentially important price levels and the general market trend, all based on what happened yesterday.
A quick but grounded view of the battlefield.
Yeah, framework. It gives you potential support areas, potential resistance areas, helping you navigate the day's trading with a bit more clarity and hopefully a plan.
And definitely not a magic bullet, but a solid tool in the toolbox, especially when combined with other analysis.
Absolutely, it's foundational.
So if listeners want to explore this more, what's the next step?
Practice.
Oh,
Seriously, the best thing is to pull up a chart, add the pivot point indicator on a demo account, no real money involved, and just watch. See how price reacts around these levels in real time.
to feel for it.
Exactly. Try combining it with simple candlestick patterns or an indicator like RSI. See what resonates with you. Observation and practice are key.
Good advice. All right, well, that brings us to the end of this deep dive. Here's a final thought to chew on. Could understanding these simple calculations, these lines drawn from yesterday's simple high, low, and close, actually be a key to cutting through all that market noise and finding clear signals day to day? Something to think about. Thanks for joining us.